Let me tell you something that's going to surprise a lot of people who followed my career. If I had to start over today with nothing but the knowledge I've accumulated over 9 decades, and I could only buy 3 stocks, and those 3 stocks had to be international companies, not American companies, I know exactly what I'd buy. Now, I understand what you're thinking, Warren. You've spent your entire life investing in American businesses. You've said repeatedly that America is the best place to invest. You've warned about the risks of international investing, currency fluctuations, different accounting standards, political risks. Why would you suddenly recommend international stocks? And that's exactly the point I want to make today. The world has changed. The opportunities have changed. And while I still believe America offers incredible investment opportunities, there are now 3 international businesses that are so compelling, so well positioned, so attractively valued that I couldn't ignore them if I were starting fresh. These aren't speculative bets on emerging markets. These aren't currency plays. These are high quality businesses with durable competitive advantages, strong management, and valuations that make them irresistible. Today I'm going to share exactly which 3 international stocks I would buy, why they meet my criteria, and how they fit into a strategy for building wealth over the next decade. Before I reveal these 3 companies, let me take you back to a moment that shaped how I think about international investing. It was 1989. The Berlin Wall had just fallen. The Soviet Union was collapsing, and everyone was talking about the incredible opportunities in Eastern Europe and emerging markets. I remember being at a conference where speaker after speaker talked about how you had to invest internationally to capture growth. They said America was mature, that all the growth was happening elsewhere, that you'd miss out if you stayed home. And I didn't buy it, not because I thought those countries wouldn't grow. They did grow spectacularly in many cases, but because I understood something fundamental. I knew American businesses. I understood American accounting standards. I understood American corporate governance. I understood American bankruptcy law and shareholder rights. When I invested in an American company, I knew the rules of the game. But when I looked at international investments, I didn't have that same understanding. I didn't know how reliable the financial statements were. I didn't know if management would act in shareholders' interests or their own interests. I didn't know what would happen if something went wrong. That the uncertainty made me uncomfortable. So I stuck with what I knew, American businesses. And that served me extremely well for decades. But here's what's changed. The world has become more standardized. International accounting standards have improved. Corporate governance in many countries has gotten much better. Information is more readily available. I can read annual reports from companies anywhere in the world instantly. I can listen to earnings calls. I can access the same information that local investors have. The playing field has become more level. And that means I can now apply the same analytical framework I use for American companies to international companies. I can evaluate their competitive positions. I can assess their management quality. I can calculate intrinsic value. The second thing that's changed is that certain international markets now offer better opportunities than American markets in specific sectors. This isn't about America declining. America is still the most dynamic, innovative, entrepreneurial economy in the world. But valuations matter. And right now, some exceptional international businesses are trading at valuations that are significantly more attractive than comparable American businesses. If I'm starting fresh with limited capital, I need to maximize my returns. That means going where the best opportunities are, regardless of geography. The third thing that's changed is my understanding of certain international markets. I've spent the past decade studying businesses around the world more intensively. I've learned about different markets, different regulatory environments, different consumer behaviors. I'm more comfortable now evaluating international businesses than I was 20 or 30 years ago. So with that context, let me tell you about the 3 international stocks I would buy if I were starting over in 2026. The first stock is a Swiss company that I believe is one of the finest businesses in the world. This is Nestle. Now, I know what some of you are thinking. Nestle? That's boring. That's a food company. Where's the growth? But that reaction tells me you don't understand what makes a great long-term investment. Let me explain why Nestle is extraordinary. Nestle is the largest food and beverage company in the world. They have annual revenue of about $93 billion. They operate in 186 countries. They own over 2,000 brands. Some of these brands you know well. Nescafe, Kit Kat, Purina, Gerber, San Pellegrino, Perrier, Haagen-Dazs, Stouffer's. These are not just products. These are brands that have existed for decades and will exist for decades more. What makes Nestle so special? First, the geographic diversification. They generate revenue from every region of the world. North America, Europe, Asia, Latin America, Africa. This diversification protects them from regional economic downturns. If one region is weak, others compensate. During the pandemic, when some countries locked down completely while others stayed open, Nestle continued operating globally and generating cash flow. Second, the product diversification. They're not just a coffee company or a chocolate company. They're in infant nutrition, pet food, bottled water, frozen foods, dairy products, coffee, confectionery, and health science. This diversification across categories means they're not dependent on any single product trend or consumer preference. If coffee consumption declines in one market, maybe pet food grows. If bottled water faces regulatory pressure, maybe their health science division grows. Third, the portfolio of brands. This is the real moat. Nestle owns brands that mothers feed to their babies. Gerber, baby food. Similac infant formula. Once a mother trusts a brand for her baby, she's incredibly loyal. That loyalty continues as the baby grows. Nestle also owns brands that become part of people's daily routines. Nescafe for morning coffee, Kit Kat for afternoon snacks, Haagen-Dazs for special occasions. These brands are embedded in consumer behavior across generations. They're not going away. Fourth, the pricing power. This is crucial. Nestle can raise prices because their brands are trusted and because food is a small part of most people's budgets. When Nestle raises the price of Nescafe by 5%, consumers don't stop buying it. They don't even notice much. But that 5% price increase flows directly to the bottom line because the cost structure doesn't increase proportionally. Over time, this pricing power allows Nestle to grow profits faster than sales. Fifth, the cash generation. Nestle generates about $15 billion in free cash flow annually. They pay about $8 billion in dividends. The dividend yield is currently about 3%. Not spectacular, but solid and growing. They've increased the dividend every year for 26 consecutive years. The remaining $7 billion in free cash flow goes to share buybacks, debt reduction, and bolt-on acquisitions that strengthen their brand portfolio. Sixth, the management culture. Nestle is a Swiss company with a Swiss management culture. They think long-term. They focus on sustainable growth, not quarterly earnings manipulation. They invest consistently in their brands. They don't cut corners. This long-term orientation aligns perfectly with how I think about investing. Now, let's talk about valuation. Nestle is currently trading at about 18 times earnings. Some people think that's expensive for a food company, but compare it to American consumer staples companies, Procter and Gamble trades at 24 times earnings. Coca-Cola trades at 22 times earnings. Pepsi trades at 21 times earnings. Nestle, with better global diversification, stronger brand portfolio, and comparable growth. Prospects trades at a significant discount to these American peers. Why? Currency concerns. People worry about the Swiss franc. They worry about European economic growth. They worry about emerging market exposure. But these concerns are overblown. Yes, currency fluctuations impact Nestle's reported earnings, but over long periods, currencies tend to revert to purchasing power parity. The Swiss franc isn't going to appreciate indefinitely against all other currencies. And Nestle manages currency risk reasonably well through operational hedging. European economic growth might be slower than American growth, but Nestle isn't dependent on European growth. They're a global company. They grow wherever consumers are growing wealthier and buying more packaged foods. Emerging market exposure is actually a strength, not a weakness. As hundreds of millions of people in Asia, Africa, and Latin America enter the middle class, they buy branded packaged foods. Nestle is perfectly positioned to capture this growth. Here's what Nestle will look like 10 years from now. Revenue will be over $120 billion. They'll continue taking market share in key categories through brand strength and innovation. Free cash flow will be over $20 billion as margins expand through pricing power and operational efficiency. The dividend will have doubled from current levels, continuing their track record of annual increases. They'll have divested underperforming brands and acquired strategic brands that strengthen their competitive position. And most importantly, they'll still be one of the most essential consumer goods companies in the world, selling products that billions of people use every day. At current prices, Nestle offers a compelling combination. You're getting a world-class business with durable competitive advantages, global diversification, strong brands, pricing power, excellent cash generation, shareholder-friendly management, and a reasonable valuation. You're collecting a 3% dividend that grows every year, and you're positioned to benefit from global consumer trends over the next decade. If I were starting over and could only buy 3 stocks, Nestle would absolutely be one of them. It's the kind of business I can own for decades without worry, that will compound wealth steadily, that will survive any economic environment. That's what great investing is about. Now let me tell you about the second international stock I would buy. This one might surprise you even more than Nestle. It's a Japanese company, and I've been very critical of Japanese stocks over the years. Japan has had decades of economic stagnation, deflation, zombie companies, poor corporate governance, shareholders treated as an afterthought. But something has changed in Japan over the past 5 years. Corporate governance reforms are taking hold. Companies are focusing on return on equity and shareholder returns. Balance sheets are being cleaned up. And there's one Japanese company that embodies this transformation better than any other. This company is Toyota Motor Corporation. Now, let me address the obvious objection right away. Warren, you've avoided auto companies your entire career. You've said repeatedly that autos are a terrible business. Commodity product, intense competition, huge capital requirements, cyclical demand, powerful unions. You've called it a business that destroys capital. And you're right, I have said all those things. And they're true for most auto companies. But Toyota is different. Toyota isn't just an auto company. Toyota is a manufacturing excellence company that happens to make automobiles. Let me explain what makes Toyota extraordinary. First, the production system. The Toyota production system, often called lean manufacturing, is the most efficient production process ever developed for complex manufacturing. This isn't marketing hype. This is studied in every business school. Companies across all industries try to copy Toyota's methods. What does it mean in practice? Toyota can build a car with fewer man hours, less inventory, fewer defects, and lower capital requirements than any other major automaker. This cost advantage is enormous and durable. It's not based on paying workers less. It's based on organizing work better. Other companies have been trying to replicate Toyota's system for 50 years, and they still can't match it. Why? Because the Toyota production system isn't just a set of techniques. It's a culture. It's a way of thinking about continuous improvement that's embedded in every employee at every level. You can't copy a culture. Second, the quality and reliability reputation. Toyota has spent decades building a reputation for making vehicles that last. When someone buys a Toyota, they expect it to run for 200,000 miles with minimal problems. And Toyota delivers on that expectation. This reputation is priceless. It means Toyota vehicles retain value better than competitors. It means customers are loyal and come back for their next vehicle. It means Toyota can charge a premium price relative to comparable vehicles from other manufacturers. Third, the hybrid technology leadership. Toyota invested heavily in hybrid technology, starting in the late 1990s when everyone thought it was a waste of money. They launched the Prius in 1997. It was mocked initially, but Toyota persisted. They refined the technology. They improved it generation after generation. And now, almost 30 years later, Toyota has sold over 20 million hybrid vehicles. They have the most advanced, most reliable, most efficient hybrid technology in the industry. And hybrids are having a moment. While everyone focused on pure electric vehicles over the past few years, many consumers discovered they don't want the range limitations and charging hassles of pure EVs. They want the efficiency of electrification, but with the convenience of gasoline. That's exactly what hybrids provide. Toyota's hybrid sales are growing rapidly, and they have a technology lead that competitors are years behind in matching. Fourth, the geographic diversification. Toyota sells vehicles in over 170 countries. They manufacture in about 30 countries. This global footprint provides stability. When one market is weak, others compensate. North America, Europe, Japan, China, Southeast Asia, they all contribute to Toyota's revenue and profits. Fifth, the balance sheet. This is what really sets Toyota apart from other automakers. Toyota has net cash of about $40 billion. $40 billion. They have no net debt. In fact, they have more cash than debt. This fortress balance sheet means Toyota can weather any economic downturn. They can invest in new technology without borrowing. They can buy back shares. They can increase dividends. Compare this to American automakers who typically carry huge debt loads and face financial stress every time the economy weakens. Toyota's balance sheet is a massive competitive advantage. Sixth, the shareholder returns. This is where the corporate governance transformation shows up. Toyota has become much more shareholder friendly over the past 5 years. They're buying back shares aggressively. In the past 2 years, they've repurchased about 5% of shares outstanding. They've increased the dividend substantially. The current dividend yield is about 2.5%. They've announced plans to continue both buybacks and dividend increases. This represents a major shift from the old Japanese corporate culture of hoarding cash. Now let's talk about valuation. Toyota is currently trading at about 9 times earnings. 9 times. For a company with the strongest competitive position in its industry, net cash on the balance sheet, growing profits, increasing shareholder returns, and leadership in hybrid technology. Compare this to American automakers. General Motors trades at about 5 times earnings, but they have net debt and much weaker competitive positions. Ford trades at 6 times earnings with similar issues. Tesla trades at 70 times earnings with questionable profitability and intense competition emerging. Toyota at 9 times earnings is attractively valued for a high-quality business. Why so cheap? Concerns about electric vehicles. Investors worry that Toyota is behind on EVs. They think Toyota bet wrong on hybrids, while Tesla and others focused on pure electric. But I think this narrative is completely wrong. Toyota isn't behind on EVs. They're being strategic. They're watching the market develop. They're waiting for battery technology to improve and costs to come down. And in the meantime, they're selling millions of hybrids that are profitable today. When the pure EV market truly takes off and battery costs decline enough to make EVs profitable at mass market prices, Toyota will launch EVs at scale. They have the engineering capability. They have the manufacturing excellence. They have the global distribution network. They'll be fine. And here's what most analysts miss. The transition to EVs will take much longer than people think. It's going to be decades, not years. Internal combustion. Engines and hybrids will still represent the majority of vehicle sales in 10 years, maybe even in 20 years. During that entire transition period, Toyota will be selling profitable vehicles while competitors lose money trying to force an EV transition that the market isn't ready for. There's also concern about China. Toyota's China sales have been soft recently as Chinese consumers increasingly buy domestic brands. This is a real issue. But Toyota's China exposure is only about 15% of total sales. And they're growing rapidly in other markets like India and Southeast Asia. The geographic diversification protects them. Here's what Toyota will look like 10 years from now. They'll still be the world's most profitable automaker. They'll have expanded their hybrid portfolio to include hybrid versions of nearly every model. They'll have launched a competitive EV lineup in markets where EVs make economic sense. They'll have continued buying back shares, retiring perhaps 15 to 20% of shares outstanding over the decade. They'll have doubled the dividend from current levels. They'll still have a fortress balance sheet with net cash, and most importantly, they'll still have the best production system, the best quality reputation, and the strongest competitive position in the industry. At current prices, buying Toyota at 9 times earnings is a gift. You're buying the best business in a challenge industry at a valuation that reflects fear, not fundamentals. You're collecting a 2.5% dividend that's growing. You're benefiting from aggressive share buybacks, and you're positioned to profit from the reality that the EV transition will be much slower than the hype suggests. If I were starting over, Toyota would absolutely be one of my 3 international stocks. It's the rare auto company that actually deserves to be owned long-term. Now, let me tell you about the 3rd international stock. This one represents a bet on a trend that I believe will dominate the next 2 decades. Aging populations in developed countries, rising healthcare spending, demand for pharmaceuticals. The company is Novo Nordisk, based in Denmark. Novo Nordisk is a pharmaceutical company that specializes in diabetes care and obesity treatment. They're the world leader in insulin production. They invented modern insulin therapy. They have about 32% of the global insulin market, but that's not why I'm interested in them. I'm interested because they've developed a class of drugs that's revolutionizing the treatment of obesity. These drugs, called GLP-1 agonists, are game changers. Let me explain what's happening here and why it's so significant. Obesity is a massive global health problem. Over 600 million adults worldwide are obese. In the United States, about 40% of adults are obese. Obesity causes or contributes to diabetes, heart disease, stroke, cancer, joint problems, and numerous other conditions. Healthcare systems spend hundreds of billions treating obesity-related diseases for decades. The only effective treatment for severe obesity was bariatric Surgery, diet and exercise help, but most people can't sustain the lifestyle changes needed to lose significant weight permanently. Drugs existed, but they had limited effectiveness or serious side effects. Then Novo Nordisk developed these GLP-1 drugs. Initially for diabetes treatment, they noticed patients were losing significant weight as a side effect, so they researched higher doses, specifically for obesity treatment. The results have been remarkable. These drugs help people lose 15 to 20% of body weight on average. That's transformational. Someone who weighs 240 pounds can lose 40 to 50 pounds. This level of weight loss significantly reduces risk for diabetes, heart disease, and other conditions. The demand has been extraordinary. Novo Nordisk can't manufacture these drugs fast enough. They're sold out globally. They're investing billions in manufacturing capacity. They're raising prices, and still they can't meet demand. Why am I so excited about this business? First, the market size is enormous. If even 10% of obese adults worldwide use these drugs, that's 60 million patients. At current pricing of about $1,200 per month, that's over $800 billion in annual revenue potential. $800 billion. Even capturing a fraction of that market represents massive growth opportunity. Second, the competitive moat. Novo Nordisk has a huge lead in this drug class. They've been developing these drugs for over 15 years. Their manufacturing is complex. Their clinical data is extensive. They have patents that provide exclusivity for years. Yes, competitors are developing similar drugs. Eli Lilly has a competing product. Others are in development. But Novo Nordisk is years ahead in manufacturing scale, clinical evidence, and market presence. They'll dominate this market for at least 5 to 10 years, maybe longer. Third, the economics are extraordinary. These drugs have gross margins over 80%. The manufacturing cost is relatively low. Most of the revenue flows to the bottom line. As Novo Nordisk scales production, margins will expand further through operating leverage. Fourth, the recurring revenue model. Patients taking these drugs need to take them indefinitely. If they stop, the weight comes back. This creates a subscription-like revenue stream. Once Novo Nordisk gets a patient on their drug, they have that patient for years, maybe decades. The lifetime value of each patient is enormous. Fifth, the expansion potential. These GLP-1 drugs are being tested for numerous other conditions beyond diabetes and obesity. Heart failure, kidney disease, liver disease, Alzheimer's, sleep apnea. Early studies show promise in many of these areas. If the drugs are approved for multiple indications, the market expands dramatically. Now let's talk about valuation. Novo Nordisk is currently trading at about 33 times earnings. That's expensive on the surface, but you need to understand what you're buying. You're buying a company growing revenue at 30 to 40% annually. You're buying a company with gross margins over 80%. You're buying a company with a dominant position in a massive, fast-growing market. You're buying a company that will likely more than double earnings over the next 3 to 5 years. When you think about it that way, 33 times earnings isn't expensive. If earnings double in 4 years, you're really paying 16 times forward earnings. And if the stock goes nowhere for 4 years while earnings double, you'll have a 15 to 20% annualized return just from earnings growth. More likely, the stock will appreciate as earnings grow, giving you much better returns. Why isn't the stock even more expensive? Concerns about competition. Investors worry that Eli Lilly and others will take market share. Concerns about pricing pressure. Governments and insurers are pushing back on high drug prices. Concerns about long-term safety. These are new drugs. We don't have 20 years of safety data. What if problems emerge These concerns are legitimate, but they're manageable. On competition, yes, there will be other drugs, but the market is so large that multiple companies can succeed. Novo Nordisk doesn't need to dominate the entire market. They just need a significant share. On pricing, yes, there will be pressure, but even at half the current price, these drugs are incredibly valuable. They prevent diseases that cost far more to treat. The economics work even at lower prices. On safety, the clinical data so far looks good. Millions of patients have taken these drugs. The side effects are mostly mild, gastrointestinal issues. Serious problems are rare. Obviously, longer-term data will provide more confidence, but the risk-benefit profile looks favorable. Here's what Novo Nordisk will look like 10 years from now. They'll be one of the largest pharmaceutical companies in the world by market cap. Revenue will be over $100 billion, up from about $40 billion today. Most of this growth will come from obesity drugs, with additional contributions from diabetes drugs and new indications. They'll have multiple competitors in the obesity space, but they'll still be the market leader. They'll have expanded manufacturing capacity dramatically to meet global demand. They'll have launched next-generation drugs with improved efficacy or convenience, maybe once monthly, injections instead of once weekly, maybe oral formulations instead of injections. They'll be generating over $30 billion in free cash flow annually. They'll be paying a growing dividend and buying back shares. And most importantly, they'll be helping hundreds of millions of people lose weight and improve their health. At current prices, buying Novo Nordisk is a bet on a healthcare revolution. You're buying a dominant player in a massive market that's just beginning to develop. You're buying extraordinary growth at a reasonable valuation. You're positioned to benefit from one of the most important medical advances of the 21st century. If I were starting over, Novo Nordisk would be one of my 3 international stocks. It's the kind of opportunity that comes along once a decade. Now, let me bring this all together and talk about how these 3 stocks work as a portfolio. Nestle, Toyota, and Novo Nordisk. What do they have in common? First, they're all dominant players in their industries. Nestle is the largest food and beverage company. Toyota is the most profitable automaker. Novo Nordisk is the leader in diabetes and obesity treatment. Market leadership provides pricing power, economies of scale, and competitive advantages. Second, they all have durable competitive moats. Nestle has brand power. Toyota has manufacturing excellence and quality reputation. Novo Nordisk has technological leadership and patent protection. These moats protect against competition and allow them to earn above average returns on capital. Third, they all generate substantial cash flow. Nestle generates $15 billion in free cash flow. Toyota generates about $25 billion. Novo Nordisk generates about $12 billion. This cash funds dividends, buybacks, and reinvestment in the business. Fourth, they all have shareholder-friendly management. Nestle pays consistent dividends and buys back shares. Toyota has embraced shareholder returns after years of hoarding cash. Novo Nordisk pays dividends and reinvests aggressively for growth. All 3 prioritize shareholder value. Fifth, they all benefit from long-term secular trends. Nestle benefits from global population growth and rising middle-class consumption. Toyota benefits from the reality that vehicle electrification will be a decades-long transition. Novo Nordisk benefits from rising obesity rates and aging populations. These trends will play out over decades, providing sustained growth opportunities. Sixth, they're all reasonably to attractively valued. Nestle at 18 times earnings is cheaper than comparable American consumer staples. Toyota at 9 times earnings is cheap for a high-quality business. Novo Nordisk at 33 times earnings is reasonable for a company growing earnings at 35% annually. You're not overpaying for any of these. How would I allocate across these three stocks? If I were starting fresh, I'd put about 40% in Nestle, 30% in Toyota, and 30% in Novo Nordisk. Why this allocation? Nestle is the foundation. It's the most stable, most predictable, most defensive of the three. It's the business I'm most confident will look very similar 10 years from now. It provides ballast to the portfolio and a steady dividend. Toyota is the value play. At 9 times earnings with a fortress balance sheet, there's limited downside. And if I'm right that the EV transition is slower than expected, there's significant upside. This is a position where you can afford to be patient. Novo Nordisk is the growth engine. It's the most expensive on a multiple basis, but it has the highest growth rate and the largest opportunity. It's also the riskiest because it depends on successful execution in a rapidly evolving market. That's why I limit it to 30% of the portfolio. This allocation gives you stability from Nestle, value from Toyota, and growth from Novo Nordisk. It's a balanced portfolio with different characteristics and risk profiles. Now let me address some objections I anticipate. First objection is currency risk. All three of these companies report in foreign currencies. Nestle in Swiss francs, Toyota in yen, Novo Nordisk in Danish kroner. If these currencies decline against the dollar, your returns will be reduced when converted back to dollars. This is true. Currency risk is real. But it works both ways. If these currencies appreciate, your returns are enhanced. Over very long periods, currencies tend to revert to purchasing power parity. I'm not overly concerned about currency risk on a 10 or 20-year time horizon. Second objection is political and regulatory risk. These companies operate under different regulatory regimes than American companies. Switzerland, Japan, and Denmark have different laws, different corporate governance standards, different political systems. What if something goes wrong? This is legitimate, but all three of these countries are stable democracies with rule of law. They respect property rights and shareholder rights. They're not expropriating foreign investors. Switzerland and Denmark are among the best governed countries in the world. Japan has made major strides in corporate governance. The risk is much lower than investing in emerging markets with unstable political systems. Third objection is accounting standards. These companies report under IFRS, not US GAAP. The accounting standards are different. This makes comparisons more difficult, but IFRS is a high-quality accounting framework used by most developed countries. The financial statements are reliable and audited by major accounting firms. Yes, you need to understand the differences between IFRS and GAAP, but they're not so different that you can't analyze the businesses. Fourth objection is information access. You might worry that you won't have access to the same information as local investors, but in today's world, information is widely available. All three companies publish detailed annual reports in English. They hold earnings calls that anyone can listen to. They disclose material information publicly. You can get the same information whether you're in New York or Zurich or Tokyo or Copenhagen. Fifth objection is tax complexity. Owning foreign stocks can create tax reporting requirements. Foreign dividends may be subject to withholding taxes. You may need to file additional forms. This is true, but the tax complexity is manageable. Your broker will handle most of it. And the withholding taxes on dividends are often reclaimable against your US taxes through foreign tax credits. Yes, it's slightly more complicated than owning American stocks, but the incremental complexity is minimal. Sixth objection is, why not just buy American companies and avoid all these issues? This is the most fundamental objection. And my answer is that you're giving up returns by limiting yourself to one country. The world is a big place. Great businesses exist everywhere. If you only invest in American companies, you're ignoring 90% of the world's public companies. You're likely to miss opportunities. Now, I'm not saying you should invest predominantly internationally. America is still the best market in the world for long-term investing. Most of your portfolio should probably be American companies or funds that hold American companies, but having some international exposure, especially to high-quality businesses in developed markets, makes sense. It provides diversification and access to opportunities that don't exist in America. These three stocks, Nestle, Toyota, and Novo Nordisk, they're not available in the American market. You can't buy comparable American businesses with the same characteristics. Nestle's global brand portfolio is unique. Toyota's manufacturing excellence is unmatched. Novo Nordisk's leadership in obesity drugs has no American equivalent. By limiting yourself to American stocks, you'd miss these opportunities. Let me share some lessons from my 8 decades of investing that apply here. First lesson is about expanding your circle of competence. When I was young, I only invested in businesses I could visit and see firsthand. That limited me to businesses in Omaha and surrounding areas. As I got older, I expanded my circle to include businesses across America. Then I started looking at some international businesses. My circle of competence has expanded over time through study and experience. You should do the same. Don't let fear of the unfamiliar prevent you from investing in great businesses. Expand your knowledge, learn about different markets and different companies. Your investment opportunities will multiply. Second lesson is about the importance of quality over geography. The location of a company's headquarters matters much less than the quality of the business. A great business in Switzerland is a better investment than a mediocre business in America. Focus on business quality, competitive advantages, management quality, financial strength. If a business has these characteristics, the geography is secondary. Third lesson is about valuation discipline. Even great international businesses can be bad investments if you overpay. All three of these stocks meet my valuation criteria. I'm not paying expensive multiples hoping for continued expansion. I'm buying at reasonable to cheap prices where I have a margin of safety. This discipline protects me if I'm wrong about the business or if things don't work out as expected. Fourth lesson is about long-term thinking. I'm not buying these stocks to trade them. I'm buying them to own for years or decades. This long-term orientation changes everything. Short-term currency fluctuations don't matter. Quarterly earnings don't matter. What matters is where these businesses will be in 10 or 20 years. And I'm confident all three will be substantially more valuable. Fifth lesson is about diversification. Even with high conviction, I'm spreading my capital across 3 different stocks in 3 different countries in 3 different industries. This protects me if I'm wrong. About any individual stock, diversification is essential even when you think you know what you're doing, especially when you're investing internationally where you have less familiarity. Let me close with some specific action steps. First, do your own research. Don't just take my word about these companies. Read their annual reports, study their businesses, understand their competitive positions, form your own opinion about whether they're good investments. Second, start small if you're uncomfortable. Maybe allocate 5 or 10% of your portfolio to these 3 stocks. As you get more comfortable and gain experience, you can increase your allocation. Third, use dollar cost averaging. Don't put all your money in at once. Buy gradually over several months. This reduces the risk of buying at a temporary peak. Fourth, hold for the long term. These are not trading stocks. These are businesses to own for years. Ignore short-term volatility. Focus on the underlying business performance. Fifth, reinvest dividends. All 3 of these companies pay dividends. Set up automatic dividend reinvestment. This accelerates your wealth building through compounding. Sixth, monitor the businesses annually. Read the annual reports. Listen to earnings calls. Make sure the investment thesis remains intact, but don't obsess over daily stock prices or quarterly results. My final thought is this: the world is a big place full of great businesses. By limiting yourself to American stocks, you're ignoring most of the world's opportunities. Yes, international investing involves some additional complexity. Yes, there are risks to consider, but the opportunities outweigh the challenges. These three stocks, Nestle, Toyota, and Novo Nordisk, they represent the best of international investing. High-quality businesses with durable competitive advantages, strong management, good valuations, and long-term secular tailwinds. If I were starting over in 2026 with the specific constraint of buying only international stocks, these three would be my choices. They provide the foundation for building substantial wealth over the next decade and beyond. They're businesses I can understand, value, and hold with confidence. That's what great investing is about. Finding exceptional businesses at reasonable prices and holding them patiently while they compound. The geography is secondary. The business quality is what matters.